This long video covers Chapter 18, Analysis and Valuation of Bonds. I'm assuming here that you've read the previous chapter on bonds, or you had some experience with bonds in the past, so you get comfortable with them. I'm going to assume you don't know a whole lot about it, but you should become comfortable reading the previous chapter, Chapter 17. I will start from scratch basically when it comes to the valuation of bonds. So the first thing we want to do is we want to talk about some basic bond quotes, because bond quotes appear on the web in newspapers, and bond quotes can be tricky. And the point is, you have to be very careful as to how these bonds are quoted. Are they quoted in decimal form, or are they quoted in fractions? And even though it's in decimal form, believe it or not, it really implies that it's built into, there's fractions built into it. So let me give you an example. If you were to go, for example, to the Wall Street Journal, look under tips. Treasury Inflation Protected Securities tips. They've been out for about 20 years now. And these are Treasury securities that are designed to protect investors against inflation. And those securities are priced in fractions in 30 seconds. And let me explain. You often, and this is there's some important concepts coming out here. Most par value of bonds are $1,000. The par value of nearly all bonds. And so if you wanted to buy a bond, the par value associated, that would be $1,000. Now, often it's convention that the bond is priced as a function of 100. So par value really means $100, or a quote of 100. Now, the difficulty comes in, and the fractions come into play when you have something denominated. You have a bond that's priced other than $100 or $1,000 here. And for example, you would see in the Wall Street Journal a quote such as this. Now, this quote, if you saw a quote in general, anywhere for a bond here, this would be a bond quote that is a function, is a quote, but it really represents a bond that has a par value of $1,000, and this is its market value. It could be that the market value is this, $1,021.30. In which case you just move the decimal over. It could be that, but you need to read the fine print and look at the footnotes of the quote, because it could very well be in fractions, and this is what I mean. The fractions come into play here. This would be a 102, and you'd add a 0 to this, because this is, you just basically multiply this by 10. You add a 0. And this, to the right of the decimal, is the number of 30 seconds of $10. Because every time you change this see this 2, this digit, every time you change this digit, you move the bond price by $10. So the price of the bond would be $1,020 plus 10 times 1330 seconds. And so this turns out to be $4.06. So the value of this bond is $1,024.06. Now, as I will tell you in class, I'm not going to ask you to know this or to be able to recite this on an exam, but I'm just warning you, be careful when you're looking at various quotes. Now, you won't need a financial calculator in this course. You can price a bond. The value of a bond is simply the present value of its future cash flows. And so the story hasn't changed in terms of this course and what I've been telling you all semester, that the value of any financial asset is the present value of its future cash flows. Now, following the symbols that are used in your textbook, and every textbook is different, I'm going to try to follow the symbols here, and as best I can, in various places. In some places, the formulas may not be apparent in the text, so I'll try to keep consistent with what they have there. But so the price here, what I'm saying here is the market price of a bond is equal to its coupon payment. And the coupon payment is simply the par value times the coupon rate. Okay, if it's an annual bond, and you're going to chop that in half, it's a semi-annual bond. And I'll talk about semi-annual bonds in a minute here. So you remember this from your previous finance course, or something like this. The formula can be written in a number of different ways. Not only can the symbols change, but the actual way the formula is written can be different. But it all boils down to the same thing. The value of an annual paying coupon bond, the value is equal to the present value of the future of the coupon payments, which is, think of it as an annuity. So this is the present value of an annuity factor in this giant brackets here. And then here is the face value that you get back at maturity, which is mostly, and in this class, in terms of dollars, it'll be $1,000 in this class. So here we're calculating what is the value of that $1,000 today. So this is the present value of that cash flow. This is the present value, and this is a lump sum payment here. And this is an annuity. It's the present value of the annuity. So a bond is composed of two components, an annuity plus a fixed lump sum payment at the end of $1,000. Now, if it's a semi-annual bond, meaning that the payments, timeline is helpful, you get 1, 2 years. The payments are every 6 months, which is semi-annual. You have to take the coupon, and the coupon is always specified. The coupon rate is always specified on an annual basis, so it covers an entire year. Interest rates are always specified on an annual basis, so the coupon and the interest rate cover a year. But when you have bonds that actually pay semi-annually, and nearly all of them do, you have to chop the coupon in half. Meaning you're going to get C divided by 2 here, C divided by 2, C divided by 2, C divided by 2. So this is the coupon. It could be, $30 divided by 2 is 15, and so on. That's your cash flow each period. So your coupon's going to get chopped in half. And what you also have to do is you have to chop the interest rate that covers this period in half. So we divide I by 2 in each place. So it's 3 different places. And don't forget, we have 1, 2. We have 2 semi-annual periods for every year. So you need to multiply this by 2. So if this was a quarterly bond, and I suppose there's quarterly bonds out there, but they're not. I don't think there's very many of them. But there's so many different types of bonds out there. I don't want to make a statement that they're not out there, but there's got to be some out there. If this is a quarterly bond, then you would take all these 2's, divide it, and you'd put 4 in its place, because you would have 4 periods, 1, 2, 3, 4 periods in a year. Okay, so that's how you do it semi-annual. This formula, if you don't have a financial calculator, this is the formula that you're forced to use. I would strongly advise a financial calculator so you don't have to do this. It becomes a lot easier. Now, let's talk about yield. So the bond's returns, or what's sometimes called a promised yield, is called the yield to maturity of the bond. And the bond's yield to maturity is, there's a formula for approximating that yield to maturity. And that formula is, you take the annual coupon, because remember I told you returns, which is basically what a yield to maturity is, and interest rates are always specified on an annual basis. So we want this yield to maturity on an annual basis. So we take the annual coupon, even if the bond pays semi-annually. And we're going to have to reflect, and we want to reflect, the bond's price that varies and differs from its par value, because a bond that differs from its par value is going to have a premium or a discount associated with it, and you're going to get a capital gain or a capital loss. And I'll show you that in a second. But let me just cover this formula. It'll make more sense. Okay. So this formula basically is a return. Remember when you had returns, and this is, in a sense, a total return. This is the cash flow that's being thrown off by the bond. And then what we're doing here is we're looking at the capital gain or capital loss, the difference between the face value of 1,000 and its price divided by n. This is your capital gain, and an estimate, which is the squiggly equal sign, meaning estimate, of the capital gain you get each year. And then you're dividing it by the face plus the price divided by 2. It's basically giving you an average price that you're going to be facing with this investment. So, for example, if we had, I'm just making numbers up at the top of my head, here we have quoted in thousands, in dollars, we have a bond price, and in our standard quotes, 100. Now, let's say we have a bond that's 1,040. That's the price. It'll be quoted as 104. If you had a bond that was 950, it would be quoted at 95 in convention. Now, remember that when you buy a bond, right? So let me just back up 1 second here. When you have a bond, you start out at time 0, and I'm going to work on an annual basis on this case. I'm going to flip back and forth between semi-annual and annual because semi-annual is reality, but it's cumbersome to keep chopping interest rates in half and the coupons in half and doubling the time period. Mechanically, it gets to be a burden. So I often will flip over into annual returns for to illustrate something, and that's what I'm doing right here. I'm saying, look, right here we're at time 0 today. This is where we want to price the bond. The last coupon payment came in right at this point in time. It's already done and paid and gone. And so you're sitting here and you're valuing the bond. The next coupon is coming up right here. So if you have a $1,000 bond and the coupon is, say, 4%, that means you're going to have a $40 coupon right here, 40 each period. And then if it's a 4-year bond, just making it up here, 4-year bond, you're going to get $40 plus $1,000 back at the end. Okay? So, if this bond, for whatever reason, happens to be worth today, and we'll show you how to figure that out. Let's say the bond happens to be worth $950 today. So you're buying a bond that's $950. It's going to produce $40, $40, $40, $40 plus $1,000 over the next 4 years. Okay. Now, notice what's happening. You're buying this bond for $950, but you know it's going to mature for $1,000. So you know you're going to get a $50 capital gain over this 4-year period. But it's a $50 capital gain that's going to be spread out over 4 years. And so we want this annual this annual yield to maturity to reflect that. If you guys can see that. So let me see if I can make this work now. Here up into the formula. So the annual coupon here is $40. You can see that, $40. I'm not sure if you can see that very well. I'll put it in black. So the annual coupon is 40. The face value of the bond is 1,000. The price was $950 as we specified. So it shows you a capital gain, $50 over 4 periods. So I'm going to chop that 50 over 4 periods. And then what is the average price between what I paid $950 for here, and it turns into $1,000 in 4 years? The average price here is going to be the face plus the price divided by 2. And that will be, let's see, that'll be $9.75 is the average price over this time period. Okay. So now let's compute the yield to maturity. So the bottom, the denominator is 975. The top is going to be 40 plus this 50 divided by 4. So that's 1250. So this is going to be 5250. So this whole thing is 1250 plus the 40 gives me 5250. 5250 divided by 975 is 5.38% is the approximate yield to maturity on that. And what exactly is a yield to maturity? The yield to maturity is sometimes referred to as the promised yield of a bond. It's the interest rate that sets the present value of future cash flows equal to the price of the bond. So if you were to discount these cash flows, these $40 cash flows, plus the $1,000, if you were to take the present value based on this 5.38% discount rate, you would come pretty close to $950. I'd say pretty close. Remember, this is an approximation, an approximate formula that'll do that. So, what do we think about this bond? Is this a good bond that I'm using as an example? Well, let's look at it. The market demands, and that's what another interpretation of the yield to maturity is. The market's demanding 5.38% yield to maturity, or basically a return on this bond. But this bond is only producing 4% per year. That's it, 4%. This is not an attractive bond according to the market. So the market's going to have it set this bond, the price, at a discount. And there we see it, at a discount. They're shaving $50 off this bond because it only pays a $40 or 4% coupon. Had this coupon rate been $53.80, just take this times 1,000, had this been 53 coupon, 53.80, then if you were to discount this 53.80 by this discount rate of 5.38%, then you can try it. You'll come up with $1,000, a $1,000 bond. In other words, when the yield to maturity equals the coupon rate, the bond trades at par value. Okay. So I can state that here. When the coupon equals the yield to maturity, it implies the bond is trading at par. If the coupon is greater than the yield to maturity, remember, think of the yield to maturity as the interest rate that the market is demanding. That implies the bond is going to trade at a premium above $1,000. And if the coupon is less than the yield to maturity, it implies the bond will be trading at a discount. And so here we have a discount for this example. Okay. Now, let's do another example. And I made up an example, different than the notes. Let's look at and I'm going to use, and I often do at times, very short-term bonds for illustration purposes, because we can mechanically go through the math. It has its advantages and disadvantages. One, you can actually see what's happening if I discount everything by hand. But the problem is, short-term bonds, you can't see some of the implications of what happens with long-term bonds. When you change things, what happens really behind the scenes and mathematically, you can't really get the gist of it. You have to use your imagination a bit. Or, and use your calculator and actually work the numbers out. But if you want to see it cash flow by cash flow, it's hard to see a 30-year bond that has 60 cash flows. and get a handle on it. And you're better off with a very short-term bond. So that's what I'm going to do. Let's look at a 2-year semi-annual bond. Two-year semi-annual bond. Let's say the coupon is 5%. And so when the coupon is 5%, that implies that $1,000 times 5% is the annual coupon is $50. Chop it in half, it's $25 per every 6-month period. Okay, so coupon, like I said before, is always on an annual basis. Let's assume a 1% yield to maturity. And the 1% implies that it's an annual rate when you see a yield to maturity here. Now, just looking at this bond, wow, look at this bond. A couple of things you should notice right off. The coupon is very, very high relative to the yield to maturity. The market only wants 1%. This bond is throwing off paying 5%. It's an attractive bond, so it's going to be trading at a premium. However, the premium is not as big as you might think it's going to be because this bond only lasts 2 years. And so it'll have a premium to it, but it won't be a gigantic premium like a 30-year bond would have on it. Okay, so let's price it according to the formula I gave you. Market price of the bond will be the coupon is 50 divided by 2. That's the semi-annual. 1. I'm chopping this. When you chop this rate, 1% divided by 2 is 0.005%. Okay? Or I shouldn't say 0.005. 0.005 is what I'm going to use here numerically. I'm going to take that to the 4th power. Divided by the 0.5%. The $1,000 face is what I get back. And so when I do this, the present value of the face, this bond, most of the bond, most of the bond's value is tied up in its par value, its face value. $980 of the bond is tied up in that. And the rest of the value of the bond is due to this, the $50 per year or $25 per semi-annual period coupon. And that is worth $98.75. So when you add these two together, you get a bond that's worth $1,079. And so you can verify that simply. This is where I said having short-term bonds comes in the. I should make this 0.5, 1 year, 1.5 years, and this is the second 2-year period where it matures. So you're going to get 25, 25, 25, 25, and then $1,000. And so if we take 25 and discount it at 0.5%, the present value of $25 discounted for 6 months at 0.5% is $24.88. Okay, and then take this cash flow, 25, 1.005 squared, the present value of $25 discounted over a 1-year period at 0.5% per period, that's worth $24.75. And you continue down the line, this is worth $24.63. This cash flow is worth $24.50. And the last cash flow, $1,000 divided by 1.005 to the 4th power. Present value is the $980.25. So the whole value of the bond within 2 cents, because I got rounding here, rounding issues, is $1,079. And so there you have it, mechanically what I'm doing. And so what I'm saying is, look, if this is the price that you observe the bond trading in the market, so the bond trades at this market price, right? and this is the yield to maturity, 1%. This is the interest rate. The 1% on a semi-annual basis is the interest rate that set the present value of the future cash flows equal to its price that you would observe in the market. I'll say it again. A yield to maturity is the interest rate that sets the present value of the cash flows, and that's what I just did here. It's the present value of all the cash flows equal to the price that you would observe in the market, then that by definition is the yield to maturity. Okay, now a couple things. Let's hammer out this. So I did it by the most simplest of formulas here. Then I did it mechanically, piece by piece, so you can visualize it. Now we can use a time value of money mode, which is what most financial calculators have. And then I can show you bond mode for some of you who have a more sophisticated financial calculator. Now, with most financial calculators, if you look somewhere on them, they'll have an N, they'll have an I/Y. N is the number of periods you're dealing with. I/Y is the interest rate per year, or really per period. You should think of it, the interest rate per period. There will also be a PTM, which is the payment or the cash flow. There'll be an FV, which is the future value at some point in the future, FV, and there will be a present value, PV button. Okay. So what you need to do is, in any time value of money problem, if you recall, you need to input 1, 2, 3, 4 to find the fifth. Or, you could put 1, 2, 3, 4 to find the fifth. So you have basically four given variables and one unknown, and you can solve these equations. So N is 4 for this problem because it's a 4 semi-annual periods, and each semi-annual period gives you a 0.5%. Oops. This is going to be in percent, so this is where one of the tricks comes in. Your calculator is going to going to ask you in terms of percent, so you're just going to put a 0.5 in, and that is a 0.5% for semi-annual period. What is the semi-annual payment? It's the 50 divided by 2, or 25. The future value is going to be $1,000 because that's what you're going to get 4 years from now, or 4 periods from now, excuse me. And then the question is, what is the present value? The present value is the price of the bond. So when you do this and you input these 4 variables and then you hit compute PV, out will pop $1,079 out of your display on your calculator. Now keep in mind, make sure that if you go to your financial calculator, I'm not sure how well this will show up, but I have a financial calculator right here. Make sure that you got this set right. Be sure that there's no BGN here, for one thing. That would imply a beginning period annuity. So if you hit second begin right here and hit enter, right? You see the BGN here? So now, look what, if I was to do this calculation, see that little B, I don't know if you can see it, but right here, there's a BGN up in the upper right-hand corner of this display. That's telling you that this time value of money mode that I have here in my calculator is set to beginning annuity. Bonds, as we are going to show in this class, are ending annuities, meaning the cash flow happens at the end of each period, not at the beginning. And a beginning annuity would have cash flows starting at the beginning of each period. So you get a cash flow today plus 1 a year from now, plus 1, 2 years from now. The cash flows are delayed with bonds, so they're ending. Your calculator is by default set to be ending. But you may, in your previous finance course or somewhere along the way, have used the beginning annuity, so you may have to flip that out to be an ending. So you hit second, begin, enter, and you should be back second. So second begin, second enter, and now you have an ending annuity. If you can see that. So I'll say it again. If you want to flip between an ending annuity and a beginning annuity, you need to hit second BGN button, so the second, and then the BGN, and then hit second again and hit enter. So you need to do that to get back and forth between beginning and ending annuities. And the other thing is, make sure that you're in the yellow mode, that your P/Y periods per year is always equal to 1. That's the way I work with it. And so if it's periods per year is 1, you'll be able to calculate using the numbers that I gave you here, this present value of $1,079. You may have payments per year 2 for a semi-annual, or 12 for monthly payments. But what I did was I adjusted for that all at the front end before I actually put it into the calculator. I mentally said, look, there's 4 semi-annual periods. Interest rate each period is 0.5%. The coupon per semi-annual period is 25. The face value doesn't change. It's $1,000 at the end. And what is the present value, the price of the bond? You could change this around, so you could put N is 2 years, the interest rate's 1%, the payment is $50, and then you'd have to monkey around with telling the calculator that it's semi-annual. It's a little confusing. Follow the way I just showed you, which means on the front end, before you actually put it into the calculator, put it all on a semi-annual basis. This way you know what you've put in there. You know you did these calculations. And you don't rely on the calculator, because there's all sorts of things that can go on behind the scenes with a calculator. You don't even know what mode it's in. So just be careful. Now, there's another mode that we can use to value a bond, and that's called the bond mode. So if you go and you hit second bond, so second button, which is the yellow button, and hit the bond button, which is right under the number 9, right? And you get in the bond mode. Your calculator is designed to value bonds quite easily based on the settlement date and the redemption date that you buy and the bond matures. The settlement date is the day that the money in the bond changes hands. So when you enter, you have a transaction date on, say, Monday, where you agree to buy and sell a bond. It may take a day or 2, up to 3 days for the bond to clear. And when the bond clears, it's the settlement date. It's when the money moves and the bond moves between parties. And so that's what it's on that settlement date, which is when the coupon interest starts accruing to you as an investor. When you get that bond, you're owed, or you start earning accrued interest, because that's when your cash actually moved. Okay? So you don't get accrued interest. You don't earn interest when you haven't yet paid for the bond. So when you actually pay for the bond settles, interest starts accruing. Okay. So now the first thing you do is when you hit second bond, you're going to see SDT for settlement date. And so let's assume that today is, in fact today is 4/17/15. So if I enter 4 dot, it's always good for me to actually do it. So if I hit 4.1715 and hit enter, what pops up on my calculator, I don't know if you can see that, maybe too much glare for you, but if you look, you can see that. It shows up as 4-17-2015. When it enters that way on your screen, you know that you've got it right. And so what you do with that is you hit the down arrow key, the down arrow key being right here, next to your on-off button on the BA2 Plus, and you hit the down arrow and it's going to ask you for the coupon rate. And so I put in 5, and I hit enter, and I hit the down arrow, and it's going to ask me for the redemption date. Redemption date, for our purposes at the moment, is just a fancy word for maturity date. And so I'm going to put in 4.1717 because 2 years later this thing will mature. Okay, same day, 2 years later. And when I hit that and hit enter, I get 4-17-2017, and I know I got it right when it displays that way. I hit the down arrow, and the redemption value, which is another fancy way of saying maturity value for our purposes, is set to be 100. So now this, be careful, your calculator is assuming quotes in terms of 100. You know, even though the bond is worth $1,000 and has a par value of 1,000, quotes are often in hundreds, like I showed you. So your calculator is going to assume it's set to be 100. You could change this to 1,000, but I just leave it at 100. And if you follow what I'm doing, things will work out nicely, as you'll see. Next, so you leave it at 100. You're gonna assume an actual number of days, not a 30-day month, but an actual. You see, then you hit the down arrow again. Don't forget down arrow. You want to have 2/Y, 2 payments per year is what that says. And if it doesn't have 2/Y there, what you need to do is you need to hit second, enter. And when you hit second enter, it'll flip to a 1/Y, which is 1 payment per year. We don't want that in this case. So all I'm telling you is if you see a 1/Y in your screen, then you need to hit second enter and it'll flip it to a 2/Y. Okay, so make sure it's a 2/Y. And then I always like to hit enter just to make sure it's in there, registered. Hit the down arrow and it'll say, whoa, one space here. Then your calculator will say YLD, which is yield, and you'll put in 1 as 1%. Enter. Down arrow. And then what'll pop up is PRI equals. And it may give you a number there, but that number is not the right number yet. What you need to do is hit compute. So hit compute, and what'll pop up, so that's in the corner here. You hit compute, and your screen will go blank for a second, and what'll pop up is 107.9000, which, again, since this is $100, and this quote that's popping out of your calculators in terms of $100, so just move the decimal over. It's not in fractions. And so the value of the bond is $1,079, just like I showed you. So, okay, so I just showed you how to calculate a bond with 1,000 different ways. So you should be able to do that quite easily on an exam. Now, let's move on. Some notes on bonds. Now, when you have a bond, let's look at zero coupon bonds. A zero coupon bond, I'm just making this up here. Let's say we have a 3-year zero coupon. Just think of that. The coupon rate is 0. So this is 0, this is 0, and the coupon is 0, but you're going to get a nice round $1,000 back if it's a $1,000 par value bond, right? So that's a zero coupon bond. So there's $1,000 that you're getting right there. So the interest rate that sets the present that sets the present value of the future cash flow is equal to the price. That's going to be called the spot rate. The interest rate that sets this to the market value here is called the spot interest rate. Now, let's just make up a number. Let's say it's $970, right? So what I'm saying is, right? What I'm saying is, take the $1,000, discount it by 1 plus. Spot rates are often designated and written in Z as a Z. It can vary. I can use Z here, and Z meaning it's a spot rate. It applies to zero coupon bonds. Okay, so here we got this one cash flow, $1,000. It's worth $970 according to the market. So what is the implied interest rate that's associated with that? That's called a spot rate. Spot rates apply to zeros. When I see zeros, I mean zero coupon bonds. So we need to discount this back 3 periods. So it's 1, 2, 3 periods. And that equals $970, right? And so you can solve this quite easily, right? You can set the 2 equal, right? And so 971 plus Z to the 3 equals $1,000. So what is the interest rate that you compound 3 years multiplied by the 970 that you invested gives you this $1,000? So you can think of this as a present value. This is 1 plus an I in interest rate to the n power equals a future value. This is basically a lump sum. There's no annuity with a 0. So you take 1 plus Z to the 3rd equals 1,000 over 970, which equals 103.09278. Look at all those decimals, just for fun. Now, what does that mean? Well, it means that just looking at this number is telling you cumulatively you're going to earn a little over 3% on this bond over its life, because you're going to invest $970. It's going to grow to 1,000. It's going to compound over all these periods. How many? 3 periods it's going to compound. You're going to earn 3% on this bond. Cumulatively, that's what the 3 is telling you, cumulatively. What is it on an annual? Oh, God, wait, back up, wrong. Put the decimal right here. Put the decimal there. So it's 1.03. It's telling you cumulatively you're earning 3%. Take it take the whole thing, because this is 1 plus Z to the 3rd power. So take both sides to the 1/3 power. So 1.0309 to the 1/3 power. And you know 1/3 power is really 0.333, so put that into your calculator. And you get 1 plus Z equals 1.0102, which translates into 1.02%. So the spot rate associated with this bond, spot rate associated with this particular bond is 1.02%. So if you earn a little over 1% for each of 3 years, this $970 will compound to $1,000. That is what a 0 is, and the interest rate associated with a 0 coupon bond is called the spot. Spot. S-P-O-T. Spot rate. Okay. So you can, as I like to tell people in my classes, you can think of the spot rate as you can spot it with your eye, because spot rates are always observed at time 0. So you can observe these spot rates right here at this point in time. They're not imaginary. They're not estimates of the future. It's a actual spot rate that you can see on the spot now. What's fascinating about bonds is, I think, is really interesting, is you can decompose a coupon bond into a portfolio of zeros. I'll say it again. You can decompose a coupon-paying bond into a portfolio of zeros. So let's say you got a 3-year 0, and obviously, back up. Let's a 3-year coupon bond. Make up these numbers here. So this is, let's say it's an annual bond that pays 9% coupon. So a 9% bond will pay $90, $90, $90, and will mature at a nice round $1,000. Okay? You can think of this 3-year coupon bond as a portfolio of zeros. 4 zeros, in fact. You can treat this as a zero in and of itself. Treat this as a zero in and of itself. Treat this as a zero in and of itself, and this is a zero in and of itself, where you can combine these two and have this last cash flow as 1,090, and you could have 1, 2, 3 zeros then. Okay, so the interest rate that would set the present value of these cash flows to its price, those interest rates, if you had a separate interest rate for each one of those cash flows, that's what a spot would be. So you can refer to this $90 divided by 1 plus Z1 to the 1 power, and you come up with a price. That would be the spot rate for this particular time period. Okay? Now you have a second cash flow that covers this, that has to be discounted over this 2-year period. That would have its own separate interest rate. Discounted for 2 periods back. So you can calculate the present value of that cash flow. Then you can calculate the present value of this last cash flow. Let's keep it combined here. And you can discount it at a spot rate that covers 3 years, covers this whole 3-year period, discounted 3 periods back. And you can compute the present value of the bond as a portfolio of 3 different zeros. Compute the value of the bond. So it's just another way of valuing a bond. You can think of a bond as being being one blob of cash flows, or you can break up each of the cash flows separately and think of them as zeros, as a portfolio, and value it that way. So imagine this. Imagine you bought a coupon bond. You bought this bond and you own it right here. You bought it and you own it right here. Imagine that you could detach and decompose the cash flows that you're going to get from that bond. So you can sell this portion of the bond, sell this portion of the bond, and sell this portion of the bond and this portion of the bond to individuals. So you could sell this to person A, sell this to B, sell this to person C, and sell this to D. The sum of all those values should equal the price of the bond in an efficient market. In other words, the value of a bond should be the sum of all its parts. Okay? Now, in the real world, the reason why I'm bringing this up is that in the real world, there are organizations that are allowed by the U.S. Treasury to take Treasury bonds and strip them of their coupons and make zeros out of them. So, if you had a bond like this, if you had a bond that paid $90, $90, $90, and $1,000, if you bought the bond, you'd be stuck with this cash flow. But there's financial institutions that'll buy this bond and they'll decompose it into 4 pieces, and they'll sell each piece. So that what you can do as an investor, you could buy this cash flow for 90. It's the present value. The price of it's the present value of this cash flow. You can buy this cash flow that's going to happen in 2 years. You can buy it today. It's the present value based on the spot, 2-year spot rate. You can buy each one of these cash flows based on its present value and then have its some 3 years spot rate. So the point is, spot rates and spots and zeros are very important in the world. And you're going to see that as we go through this chapter. Spot rates and bonds and zeros are important. And they're very helpful for analysis later on. Now what we want to do is, let's take a look now at the yield curve real carefully. The yield curve, and I've shown you this over the semester, the yield curve for the U.S. market is typically, so here's yield, here's maturity, and the maturity goes from one month all the way up to 30 years. And so we know that interest rates very short term over the next year or so are practically zero. And then interest rates start to ramp up a bit, close to around 3% for 30 years. At 10-year securities, it's a little less than 2% right now. Oops, it's not. At 10%. So the yield curve is upward sloping. It's a little weird. Typically it looks like this. Now, this is the yield curve that you will see in the Wall Street Journal. You go to Bloomberg.com, you go to a bunch of different websites, you'll see a yield curve that looks like this. This yield curve is nice, it's okay, but it's not proper for valuing bonds. It's a good estimate of what interest rates are and where they're going in terms of maturity, but it's not good to value a bond. And the reason for that is there's a number of reasons for it. Is that this yield curve is estimated based on coupon bonds. Coupon bonds that we've been dealing with under traditional bond calculations, those coupon bonds assume a single yield to maturity in the calculation. So go back to the problem I gave you earlier. I valued a bond earlier that had a 25, 25, 25, 25, and $1,000 cash flow. I discounted that bond at the same 1% yield to maturity, which turned out to be 0.5% every 6 months. I used that on each cash flow. I used the same interest rate for every cash flow. Did you notice that? You know what that assumes? That assumes that the yield curve is flat at 1%. For the next 3 years. Well, it was a 2-year bond, so it was a 2-year bond, so the maturity was 2 years, and here's the yield. I assume, as does all conventional bond pricing methods, that the yield curve was flat at 1% because I discounted the half-a-year cash flow at 1%. And, you know, I semi-annualized it, obviously, and then at 1 year I discounted at 1%, and at 1.5 years I discounted at 1%. So I assumed, and conventional bond pricing assumes that the yield curve is flat. It's not. It's a good approximation. And so what's happening here in the yield curves that you see in the Wall Street Journal and other websites is that this yield curve is looking at coupon bonds that go from the coupon bonds go from 1 year all the way up to 30 years. They have various coupons, they have various degrees of liquidity, and there's tax implications associated with these guys. So that this yield curve, you know, it's a good approximation, but it's really not what we want. We need to extract from this spot rates. We need spot rates because the theoretically correct way to value a bond is to discount each cash flow by a separate, different rate, a different spot rate. Because think about it, if your yield curve is upward sloping, then the interest rate here, Z1, for example, will be smaller than Z2, which will be smaller than Z3. So this yield curve is upward sloping, which means these interest rates on the high end, what's sometimes called the long end of the spectrum, they need to be higher. But conventional bonds and bond pricing assumes the same interest rate. And that's what we did here in this calculation, time value of money calculation, assumed the same interest rate for all of the cash flows. So what we're going to do is we're going to do what's called a bootstrapping method, and we are going to compute our own yield curve. Okay, so we're going to compute our own yield curve. And I'm on, starting on the bottom of page 3 of the notes, and I'm going into page 4. Page 4 has got a lot of calculations. Now, the yield curve that you see in the Wall Street Journal goes from 1 month to 30 years. The first year of treasuries that are outstanding are all zeros. So when you buy a 3-month treasury, a 1-month treasury, a 6-month treasury, or a 1-year treasury bill, they are zeros. They throw off no coupons. In other words, they generate no coupons. You buy them at a discount and they mature at a nice round value like $1,000 or $10,000. Okay, so the interest rates here on the very short end of the spectrum are good interest rates. They're spot rates because they're the interest rate that sets the present value of one single cash flow equal to its price. So we're happy with those spot rates, but the thing is these interest rates further on in time, going from 1 year to 30 years, these interest rates that are on the yield curve in the Wall Street Journal are coming from coupon bonds and assuming a single discount rate. And so we've got to get out of that mode of using a single discount rate, which basically is, it's an average discount rate for simplicity purposes, to make it simple in the calculations. If you had a separate cash flow for every period, you'd need a spreadsheet. And all this stuff was, all this formulas and the math and the logic for bonds was generated well before spreadsheets even existed. So the convention has been over the years to simplify the calculation using average interest rates. Now that we have spreadsheets, it's quite easy to look at compute things the proper way using individual spot rates. So what we're going to do is I'm going to show you a yield curve. So this is different than the one that's in the notes because I'll show you in class how to deal with the problem that's in the notes. I'm going to give you a very similar problem, just the numbers are different. And so here's the problem. Here's what I'm going to give you. I'm going to give you the period, 1, 2, 3, 4, 5, 6 periods for a 3-year bond, or bonds that go out, this yield curve I should say, is going out 3 periods. And when you see a yield curve, underneath the yield curve is bonds, by the way, as you'll see in a second, and you kind of know that. And so here is the yield to maturity / the coupon of these bonds. And we're going to assume that these bonds are trading at par value. And the reason we're going to assume that they trade on par value is that there's no premium or discount with a par value. Since people have different tax rates, the premium or discount on a bond would have different tax implications, and it would distort the calculations. So in order to abstract away from the problems of different tax rates that individuals have and the tax issue altogether and the implications, we look at a yield curve assuming par value. Not a problem in the real world. You can get par value bond prices quite easily. So what we need to do here is we need to fill in and compute the spot rates. We need to fill this column in. That's our goal. Okay. So what we have here is data right here. This data is your typical yield curve data for the most part. Look at the shape of the yield curve. Starts out low, goes up, flattens out, and then increases. Basically, that's what this is telling you here. And so interest rates for the first 6 months are 1%. Then covering the next year is 3%. Then covering the first year and a half is 3% also. For 2-year period, it's 4%, 2.5% is 5%, and 6% for a 3-year bond. So the yield curve is upward sloping. So now what we need to do is we need to come up with spot rates. We need to translate these numbers into spot rates. Not because these are average. These are average rates. So as I said a few minutes ago, the bonds, treasuries, and these are treasury yields. The treasuries for a half a year or 6-month bond, the interest rate associated with that is a spot rate, because 6-month treasuries, and this is a 6-month treasury, that has that interest rate associated with that is a spot. So there's no calculation. You just carry that over for both periods because 1-year Treasury bills have a spot rate. There's no coupons, so it's easy. You're just going to pull those numbers off and use them. So these are automatically spot rates, so there's no calculation. The difficulty comes in calculating the next 4 numbers, and that's going to take some math. So what we're going to do here is we're going to assume that the bonds are priced as a function of 100. We could do things in terms of 1,000, but you get an extra 0 in, that's a pain. So let's make things a bit simple. And the general formula that I'm going to use here to bootstrap the yield curve is this is the price of the bond, and then you're going to have a coupon, right? And that would be a semi-annual coupon. So that's the cash flow 1 year, 6 months from now. And we're going to discount that back at a 1 6-month period spot rate, Z1. And then if we have a second period, I'm going to discount that as Z2. This is a 1-year spot rate that covers 2 semi-annual periods. Discount that back 2 semi-annual periods. And if it's 3, if there's 3 periods, it has 3 spot rates. This is a 1.5-year spot rate. Discount that back 3 periods, and we keep doing that. Keep doing that. So that's the general formula that I'm going to be applying throughout this exercise. Okay. So now, what we're going to do is we're going to calculate this number right here. What is the spot rate associated with a 1.5-year bond, right? So here's a 1.5-year bond, 3 semi-annual periods, that has a 3% coupon. And notice the yield, as they say up here, the yield to maturity / coupon, they're the same thing because these bonds all trade at par value, 100. Right? So we know the yield to maturity and the coupon rate are all equal, as we talked about earlier. So now let's calculate this. We have a 1.5-year bond, right? That throws off a $3 coupon, right? Because the coupon is 3% on a $100 bond. Means that the coupon is $3 per year, right? Divided by 2, so it's $1.50 per semi-annual period. And we need to discount that back by the spot rate. Well, we already have that spot rate, and that spot rate on an annual basis is 1. So 1.005, because we've got to put it on a semi-annual basis. So the first coupon associated with this is $1.50, discounted at 0.5% for 1 period. Now, the next cash flow is $3 divided by 2 is $1.50, and that's got to be discounted by the 1-year spot rate, which covers 2 semi-annual periods. So the 1-year spot rate is here, 3%. But that's on an annual basis, so let's unannualize it, so to speak. That's 1.015, so it's 1.5% for 2 periods. Okay? Now, let's figure out, so what I did was I took this bond, throws off this $3 cash every year, $1.50 every 6 months, and I've just discounted 2 of the cash flows. I got to figure out what is the spot rate. What is this Z3? This is Z3 right here I'm looking for. This is Z2. This is Z1. So what is Z3? How do I calculate that? Well, on this bond, I'm going to get $3 divided by 2. I'm going to get the last coupon. Plus, don't forget, it's going to mature for $100. Okay, when I'm all said and done, and I need to discount that whole thing. So this is 101.5, $101.05 is what that equals. I need to discount that by 1 plus Z3 to the third power. Okay? So I just took this bond and I'm discounting all the cash flows by the spots that were given, and then I'm not given and I don't know what the third spot is. I'm going to calculate that third spot. And this is just an algebra exercise. This turns out to be $1.49 and change. This is $1.45 and change. And this becomes 101.5 divided by 1 plus Z3 to the third power, all equals 100. So subtract this out and you get 97.0515 equals 101.5 divided by 3 to the 3 power. There we are, back to calculating spots like I showed you a little while ago. Solve for this. Solve for Z3. And when you get Z3 equals 0.01505, but that's on a semi-annual basis. So multiply it by 2, and you'll get 0.0301. So that's our spot, Z3. On an annual basis is 3.01. Now, not very different from the actual coupon, so that doesn't do a whole lot for us. But as you have longer maturity bonds, the difference between these columns will magnify, and then they get compounded over many periods, and you can see it'll have an impact here. So as you see, as we go further along, we're going to have differences between them. And if it was a 30-year bond, there'd be could be substantial differences. Okay, so we just figured out this one. Now we want to go to Z4. What is Z4? Well, I'm just going to take this analysis that I just did, and here's where the repetition comes in. It looks like a nightmare if you've never seen this before. It looks like, holy mackerel. This just goes on forever. It's not that complicated because I'm just going to tack on another, or basically insert another cash flow onto this. So mechanically, it's the same thing, just it's going to be on calculating a Z4. Let me show you. Let's get a clean sheet here. So I'm going to set the price equal to $100, and take a look here. This is a 2-year bond, with 4 semi-annual periods. Here's the spot rates I have to discount the cash flow by for this period, this period, this period. We want to figure out what is the spot rate here based on $2 cash flows every 6 months. So it's $4 every year, $2 every 6 months. Therefore, it's the first cash flow is $2. I'll just put 4 divided by 2 is 4. Or 4 divided by 2 is 2. And the first discount rate is 0.5% for 1 period. We saw that in the previous example. The coupon is still 2%. It's a fixed coupon, which is why these are called fixed income securities. The income's fixed. This is 3% chopped in half, which is 1.5% for 2 periods. Then the third coupon is the $2 divided by 1.015. That is basically the 3.01% divided by 2. But when I do that, I lose this 0.01 in rounding. So it's not a mistake. I'm not rounding out as many decimals as I could. I don't want to go crazy with this. So this is the spot rate I just calculated a few minutes ago. Okay. Then I have the last cash flow, which is the $2 plus the $100 face value, is going to be discounted at 1 plus Z to the Z4 to the 4th power. So this is 100 equals 199 plus 194.13 plus 191.26 plus. Okay, so that's the formula. Now just calculate Z4. Well, this is $100 minus $1.99 minus $1.94 minus $1.91. So this comes out to be 94.156 equals 102, 1 plus Z4 to the fourth power. And so calculate Z4. Z4 equals 0.0202, which is on a semi-annual basis, multiplied by 2, put it on an annual basis, and there we have it. Z4 is 4.04%. And if you continue with the calculations, find it here. Yeah, so if you continue with the calculations, I found it. It's 5.094 Z5, and this is 6.1762 is Z6. So you see the differences in the interest rate starts to change between the two rates, starts only after 3 years. Okay? And so if you go 30 years, it's going to get magnified. And then, you know, it's 3 years, but you have to compound it over 3 years, and the difference gets magnified even more. So there you have it. There is bootstrapping the yield curve. Why are we doing this? Because we want clean spot rates. The interest rates that you normally get out of publications, most publications, will be coupon rates that are a bit distorted. You want spot rates. Now, let's take what we've done with our bootstrap yield curve, and let's actually use it. See, why did we go through all these calculations? Okay, so what we're going to do is let's imagine we have a bond. Let's say we have a 3.5% coupon bond. Okay, and the yield to maturity, and well, before we do that, let's look at the maturity date. Say the maturity date is it's going to have a maturity of 3 years. Okay, so if we have a maturity of 3 years, then the coupon rate that you're normally going to get, I should say the appropriate at this point, the coupon rate that you're going to employ using traditional methods of valuing bonds where you assume a single discount yield to maturity, we're going to compare that versus discounting with each of these spot rates. So what we're doing here is conventional methods would have us discount the cash flows of a 3.5 coupon bond, and I just made that 3.5% up. Conventional pricing methods would have us discount at this 6% per year. But what we should be doing is using the spot rates for each and every single period. So let's do the calculations. Let's do the actual calculation that you would, the conventional calculation, and I'll use bond mode, and you can verify it using another method. So the settlement date will be today. So I'm going to put in April 17, 2015. The redemption date will be 4.1718. The coupon is 3.5%. Maturity is the maturity, as you can see, is 3 years there. The yield, all input, will be 6%, and it'll be actual, and it'll be 2/y like I did before. Let's see, what else do I need in here? I think that's it. And I'm going to say compute price, and that will pop $93.22.85, so $932.29 is the price of this bond using conventional methods, using the 6% interest rate, coming off the yield curve like you would find in a Wall Street Journal, similar to what you'd find in a Wall Street Journal. Now what I want to do is I want to discount each cash flow based on the appropriate spot rate. And that'll take a few more calculations, so let me do it here. So you can draw a timeline if you like. Here is 6 semi-annual periods. I'm going to get $1.75. How did I calculate that? That's the 3.5%, which is I'm going to get $3.50 for every $100 par value, divided by 2 is $1.75. So 3.5% coupon on a semi-annual basis is $1.75. Right? And plus, don't forget, I'm going to get $100 at the end of the 3 years. So what I want to do is, and I don't have, I just have to write it out a little easier. So I'm going to start here. I'm going to take this $1.75 and I'm going to discount it by 0.5% for 1 period. Where did that 0.5% come from? It's this spot rate on a semi-annual basis. And then I'm going to take the next 170, and that'll be, let's see, that's $1.74.1. Then the next cash flow, this cash flow right here, is $1.75, and I'm going to discount it at this 3% spot rate, chopped in half for 2 periods. And that's worth $1.70 approximately. And then this next cash flow is going to be discounted at this interest rate. But this interest rate is so close to the 3 that it doesn't really show up. It shows up as on a semi-annual basis as 1.5%. So I'm discounting it over 3 periods, and I'm going to keep doing that. Okay, so when I get done calculating the value of this bond, notice I wanted to bring these since this is working the biggest cash flow and it has the most periods, getting this discount rate, not rounding this too much is important. And so I got the present value of the last 2 cash flows combined are worth $84 and change. So the value of this whole bond is $93.050, which is $930.50, is the actual value of the bond using theoretically correct valuation methods. The actual price of the bond that we had on the previous page was $932.29. And so we're off by about $1.79 difference, which you think, okay, that's not so much. But again, this is only a 3-year bond. Think about how this difference occurs and the compounding that takes place over a 30-year bond. But I'm not going to do all these calculations for 30 years, and neither are you. So let's just use our imaginations that if you do this for 30 years, the differences in dollar amounts are going to be much bigger. Let's turn to realized yield now. Realized yield. The reason why I'm bringing up realized yield is that if you remember when I introduced yield to maturity, I said it was the interest rate that sets the present value of the future cash flow is equal to the market price. And I also said I believe that it's sometimes referred to as the promised yield, the yield that you're promised to get when you buy a bond, but that's a little misleading, and that's what this realized yield concept is going to show you, that the yield to maturity is not necessarily the interest rate you're going to earn on a bond over the life of the bond. The interest rate that you earn over the life of a bond is the realized yield. In other words, the rate you actually earn after it's all said and done is the realized yield. You won't know what the realized yield is until the bonds matured or you sold the bond. You're out of the position. So let's take a look at an example of how realized yield works. Let's assume we have a 3-year bond, 5% with a 5% coupon. And we're going to talk, it's an annual bond. Let's get away from the semi-annual. Okay? And let's say the yield to maturity is 5%. As soon as we see that, we know the bond is trading at par, $100 or $1,000. Now, let's see that this yield to maturity depends on and assumes that we can reinvest these coupons at the 5% rate. This is what I'm saying. I'm saying, look, the yield to maturity, like I'll reiterate what I said earlier. The yield to maturity is the interest rate that sets the present value of future cash flows equal to the market price. But I'm also saying that the yield to maturity, this 5%, depends on your ability to reinvest these coupons at 5%. It sounds a little convoluted, but it's not until I show you the math. So what I'm saying is, if you want a 5% yield to maturity, you have to be able to reinvest the cash flows at 5%. And if you can't get 5% on the reinvestment rate, you're not going to earn the 5% yield to maturity. Again, I know it sounds like I'm talking in circles, but let me show you the math. Okay, we're going to price everything off at 100 so we don't have to write out an extra 0. So that means the cash flow here is $5, and it's going to be 105 at this point. So those are the cash flows of the bond. And if you were to discount these cash flows back, compute the present value of this bond would be $100. And if that's the price it trades in the market, then that is a yield to maturity, would be the 5% discount rate that we just did everything on. But now we're looking at it from a slightly different context. We're saying, look, in order to earn that 5%, you have to reinvest these cash flows at 5%. So what I'm going to do is I'm going to take this cash flow and I'm going to grow it at 5% for 1-2 years. Now, so I'm compounding forward, and I've told you before that we very rarely use future value in this class. Future value shows up as the $1,000 maturity value or face value of the bond, but there's no calculation to get that. This is just a plain old given. Here I'm going to calculate a future value, which, like I said, is not done very often. So the future value, so you buy the bond right here. It costs $100. You get $5 in cash flow right at this point. You can reinvest this. If you can reinvest this at 5% for 2 years, it will be worth oops, $5. Put that little dot right there. $5. This will be worth $50 and $5.51. Take this $5 cash flow you get in year 2, reinvest it for a year, this time period. 5 times 1.05. And that is worth $5.25. Add these three numbers up, and you get a future value of your cash flow of $115.76. So, what is the yield you just earned? You plop down $100 to buy this bond. You accumulated over the 3 years $115.76. What is the yield on that? Okay. Well, that's basically, I'm asking what is the return on that? And it turns out that this equals 0.05, 5%. So what you can see is this yield to maturity that I told you here. In order to earn this yield to maturity, you must reinvest the cash flows at the yield to maturity rate in order to earn the yield to maturity. If you reinvest these cash flows at a rate different than 5%, you're going to get a yield to maturity different than 5%. So, let's do it. Let's do a calculation. Let's reinvest the cash flows at 7% instead. Okay? So, I'm going to change this to 1.07 squared. I'm going to change this to 1.07. Okay? So when I do that, I get 5.725, and I get 5.35, and I still maintain the 105. When I add this up, I get $116.07 for a future value of all my cash flows. So all I did was grow this at 7% instead of 5. So I ended up with a little bit more money, as you can see. So 116.07 divided by 100, taken to the third power, minus 1, gives me 0.0509. Therefore, you can see that if interest rates went up in this case to 7%, I earn a yield to maturity slightly greater. I would earn a yield slightly greater than the yield maturity that I bought it at, 5%. Now, had interest rates fallen, if interest rates fell, well, let's say interest rates fell to 2%. If interest rates fell to 2%, the first cash flow would be worth $520 approximately. This cash flow in year 2 would be worth $510, and this is all in year 3 money. Plus the 105, I would have $115.30. Divide that by 100, take it to the 1/3 power, and I get 0.0486. So you see, if I reinvest, if I buy the bond, and as soon as I buy the bond, interest rates drop, and they drop from 5 to 2%, then my yield that I'm actually getting on this bond, the realized yield, when it's all said and done, is 4.86%. So, the realized yield reflects what you actually earned on the bond. It reflects the actual reinvestment rate that you employed on the bond. Now, let's go and calculate and look at what's called forward rates. You should have seen something in line with forward rates. You should have seen it in the previous finance course. You may have seen it in an economics course, but you probably won't have seen it to this detail. In economics, probably won't have gone into this as deep as I'm going to go into it, because forward rates, unless you took money in banking, forward rates, they're important to know, especially when it comes to central banking, Fed policy, monetary policy. But you know, getting into the details is another story. I'm going to get into the details because it has implications for bond pricing. Okay, let's assume away for the moment. Let's assume that there's no interest rate, there's no risk in the world. There's no interest rate risk out there. And that we're facing two strategies, two possible strategies. Okay, you can, one, you can buy a 2-year zero. Spell that, zero. You can buy a 2-year zero. Or you can buy a 1-year zero and roll it over for 1 more year at the going rate. Okay? So, let's say you're looking at these two strategies. Let's say you're indifferent between this. Let's say you don't care about risk, and so you don't care if you buy a 2-year zero, zero that covers 2 years, or if you buy a 1-year zero and then roll it over, turn it over for 1 more year. Now, when you do this in this strategy, in the second strategy here, when you roll it over, you don't know what interest rate you're going to roll it into. You know, think about it. It's now April 2015. You can lock in a 2-year rate and know what the interest rate you're going to earn. Here, you can lock in a rate only for 1 year that you can spot and observe. Remember, this is you could observe a 2-year spot rate here. You could observe and see a 1-year spot rate. But what's the spot rate going to be starting in April 2016? Don't know. Don't know where that's going to be. And so what we want to do is we want to ask ourselves, what is the implied interest rate that starts 1 year from now and covers 1 year? That is called a forward rate. And forward rates, for the most part, are different than spot rates. Spot rates you can observe right now on the spot. So, as I like to say, you can spot a spot rate right here on the spot. When I say right here on the spot, I mean you're looking at a timeline, and right here on the spot, you can observe a 2-year spot rate. Let's do an example. Let's say you observe a 2-year spot rate to be, let's say the 2-year spot rate is 6%. Okay, so let's do an example. And then I'll start a new spot rate. So we got you observe a 2-year spot rate, right, of 6%, right? You also observe a 1-year spot rate for 2.5%. Okay? And the question is, what is the forward rate for 1 year starting 1 year from now? Okay, so you observe a 2-year spot rate at 6%. You also observe a 1-year spot rate at 2.5%. What is the forward rate for 1 year starting 1 year from now? Okay. I've been doing this a long time, and I can tell you, you got to draw a timeline. So you draw the timeline. The 2-year spot rate is 6%. Now remember, when you get a spot rate, you get nearly any interest rate, it's on an annualized basis. So when I say you get a 2-year spot rate at 6%, that means you're getting 6% for the first year and 6% in the second year. In other words, on average, you're getting 6% for this whole 2-year period. Okay. Now, the other part of this problem says you also have a spot rate that covers 1 year, and that's 2.5%. The spot rate right here is 2.5% for the first year. And the question is, what is this forward rate? Now, the forward rate is denoted this way. And every textbook is different, so it's a little baffling as to the notation. But here's the notation that I'm going to use that will be consistent with the text. Use an F for a forward rate, and you're going to use a pre-subscript. Pre-subscript meaning right before the letter F, there's a T plus 1. What that means is this forward rate is starting right here. It's starting here, and then it's going to cover one period. So this post-subscript is covering this 1 year. So it's a forward rate that starts 1 year from now and covers 1 year. What is this interest rate? Because what we're saying is we are indifferent to investing for 2 years at 6% versus investing at 2.5% for 1 year and rolling it over into a mystery rate. That mystery rate is called the forward rate. Now, the formula in general for this is for a 2-period situation here is this. So let me read this formula off. This is 1 plus the spot rate, right, for 2 years, compounded for a 2-year period. It equals, meaning we're indifferent between doing this versus doing this. So we're indifferent between investing in the 2-year spot rate, this 2-year instrument at 2%, at 6% for 2 years, versus investing for 1 year at this rate, and this rate is 2.5%, and then reinvesting it at this rate for 1 year from now. So let's put the numbers in. Now notice, one thing you should keep in mind when you're doing these problems, the superscripts, the exponents, should always add up on both sides. Okay, so 2 plus 1 plus 1. Normally I don't put 1 up on an exponent because it doesn't do anything, but I'm putting it here so you can see it. There's a reason, because this plus this should equal to 2 on this side. So what you see here is, look, this is the return that you're going to get for investing at 6% for 2 years. That is going to be I write that down here, 1.06 squared. That's going to be 1236. In other words, you can think of it this way. I'm saying, think of investing $1 here at 6% for 2 years. It's worth $1.12 and change, right? Versus investing 1 year and then rolling it over. So you can put $1 in here, but remember, multiplying out by $1 doesn't do anything mathematically, but it maybe helps you conceptually see that this is a $1 investment and this is a $1 investment. We're indifferent, which means they should be equal. And if we're indifferent between them, what is this? What is the F here that makes us indifferent? So algebraically, this is what we have. So what we want to do is we want to solve for F. So it's 1.1236 divided by 1.025 equals 1 plus T plus 1 F1. And what happens is T plus 1 F1 equals 0.0962, 9.62%. Okay, So let's look at what that means here. So it's 9.62%. So in other words, back to the graph here, which will help us the timeline. We're indifferent between investing 6% for 2 years versus investing for 1 year 2.5% and rolling it over at nearly 10%. Because when we roll it over at nearly 10%, multiplying these two out, given this 9% here, we're going to end up with a little more than 12 cents in income when we're all done, regardless of which way we go. So what we have here is an interest rate that starts 1 year from now, covers 1 year. It's the rate we hope to see, we expect to see. It's the rate that's embedded or implied in actual observed spot rates. So we observed the 2 year spot rate, we observed the 1 year spot rate, and we extracted the forward rate that's implied from those. Okay, that wasn't so bad. Now, running out of paper. Let me just work something here. Let's now suppose, let's continue. Now suppose the 3 year spot rate is 5%. So I'm basically extending the problem I just looked at. What must the 1 year forward rate, what must be, what is B, I guess, the 1 year forward rate starting 2 years from now. In other words, F plus 2, F1. That is the interest rate that starts 2 years from now and covers 1 year. Okay, here we go. This is 5%. 5% per year, as I just wrote. Okay? We know that this is 2.5%, and we know that this is 9.62%. We just figured it out. So now, what is T plus 2F1? That is the forward rate that starts 2 years from now, right at this point, and covers this 1 year period. Okay? Well, we can figure that out using the same math we just did. We'll say, look, we're indifferent between investing, so we have an investment strategy where we're indifferent between investing for 1 year, 3 years, at 5%. Right? You can put $1 here, multiply it out, but it doesn't do anything again. Times 1.025, so basically investing $1 at 2.5% for a year, times 1.0962, covers this time period right here, times 1 plus T plus 2 F1 here. Okay. Now, solve this algebraically. It's one equation, one unknown. And when you do that, you will get 1.03028 equals 1 plus T plus 2 F1. That means T plus 2 F1 equals 0.03028, or 3.028%, which you can't see. All right. So there it is. There's the well, as best as the calculation I'll show you. You can do the algebra to solve for this one equation, one unknown. So this, get rid of the equal sign. This is 3.028%. So here, the way to interpret this is, hey, I'm indifferent between investing at 5% for 3 years versus 2%, 2.5% for 1 year, 9.62% for the second year, and 3.028% the next year. Because when I'm all said and done, both strategies will give me $1.1576, almost $1.16 when I'm done. Because this will equal $1.1576. This whole side will equal. This whole side will equal $1.1576. This equals $1.1576. So we're indifferent between the two, and the interest rate that's embedded in these spot rates is right here, 3.028. Now, it's important to know what these interest rates are, because these interest rates are the market's consensus for future interest rates. Do you see that? If people are betting on treasuries, for example, 3-year treasuries, a 3-year spot rate to have 5%, and another 1-year spot rate to be 2.5%, and then you could have a spot rate that covers, and you can try this yourself. What is the spot rate that covers now to 2 years? It's nothing but the weighted average, geometric average of these two. In other words, the interest, the forward rate that starts right now, sometimes called a spot rate. And by the way, I should let you know that the very first forward rate and the spot rate are one and the same thing. So this first 2.5%, that is a forward rate that starts right now and covers a period. That's the spot rate. You can also have a spot rate that goes out 2 periods, right? And that would be a 2-year forward rate. And so the way to calculate that is the 2-year forward rate, if you wanted to do that, would be subscript 0, because it starts t plus 0, and it covers 2 years. Okay, and that would equal, in this case, 1.025 times 1.0962 to the square root power. And so that would equal, give me a second, get a calculator. This equals, wow, I should have saw that coming. 1.06, this should be 1 plus, 1 plus. And t plus 0 f2 equals 0.06, or 6%, which is exactly what the 2-year forward rate was earlier that I showed you a second ago in the calculations. So what I'm saying is this 2-year spot rate covers a 2-year period. This 2-year spot rate, right, is also could be considered a 2-year forward rate, because you're looking at it right here, forward rate starting right now. Okay. Now, why do we care about this? Don't laugh. The Federal Reserve is concerned about this type of information, because the Federal Reserve is sitting there, they're sitting at time 0 right now thinking, okay, we can spot what the interest rates, what various interest rates are. But I wonder what forward rates are going to be. What are interest rates going to be 1 year from now that cover a year? Or what's the interest rate 1 year from now that's going to cover 2 years from now? They're concerned about that because that's what monetary policy is all about. That's what the debate is all about. Where are interest rates going? And when they change interest rates, it's going to influence bond prices and bond portfolios. So if interest rates go up unanticipatedly, unexpectedly, interest rates go up, your bond portfolio is going to drop in value. And so macroeconomics and a course in what's called money and banking, the subject of money and banking, is all about how the Fed uses the banking system to manage interest rates as best it can. And so it tries to influence future interest rates. So the math behind that is something like this. So you got a spot rate that covers a certain period of time, compounded out for the whole period of time. That equals 1 plus the spot rate, the next spot rate, the very short-term spot rate, plus 1 plus T plus 1 F1. That's the next forward rate for another year. So let's look at this all from an annual basis. And then you think of it as 1 plus T plus 2 F2, and it just keeps going for n periods. Okay? So what I'm saying is long-term rates are a function of a bunch of short rates. This is a short-term 1-year rate, and this is a 1-year rate. So we have this entire period covered by Zn, and you have Z1 covers this period, and then because that's a spot rate, you can see it. And by the way, it happens to be the very first forward rate that's out there. And then you have a forward rate that starts here, this guy, and the forward rate that starts 2 years from now, and so on. And so what the Fed does is, historically, it's been able to influence primarily this number, well, primarily the Z1, through its monetary policy, changing the Fed funds rate and buying treasury bills. Remember we covered that open market operations, and it's buying treasury bills, changing the money supply, influencing interest rates. Well, all by itself, mechanically, that does almost nothing to long-term bonds. Because we got a long-term bond, it's 30 years long, right? So assume this is 30 years. All the Fed mechanically can do is influence the very short end of the maturity spectrum. Like over a year less, not even a year, because it's buying treasury bills. Sometimes they're 3-month treasury bills. That's a traditional classical method of monetary policy. And so it would what we call jawbone and talk about and signal that it was going to change monetary policy, and mechanically all it could do is change this interest rate right here. The rest of these interest rates remain unchanged, and so long-term interest rates would barely budge mechanically. So the Fed jawbones and talks the markets into telling the markets that, look, we're going to change monetary policy for the long run. We're not only going to change it over the next couple of months, but we're going to continue to move in a direction of either easing up on monetary policy to lower interest rates or clamping down on monetary policy to raise interest rates. And so the market listens. The market has expectations, anticipates that, and the buying and selling would cause 30-year, 25-year, 20-year treasuries to change price, which would mean it changes yield. Now, that is a sloppy way of doing things. Some people refer to this as the Fed pushing on a string. So you push on this little part of the string, it crumples up because the rest of this doesn't move hardly. And only this part crumples up, this component right here. So the Fed is now turned recently, I say now, in the past 7 or 8 years, has realized that it has to buy long-term treasuries to be even more effective. And so if it buys long-term treasury, it pushes up their price and lowers the yield. The lower interest rate means that the market, the economy is facing lower interest rates, lower borrowing costs, and companies can expand cheaper. And so it moves the economy, hopefully, out of a recession or slow growth and into a stronger growth. So now, that's the end of this video. What I will cover next will be bond volatility and duration analysis, which presupposes you have the understanding that I just gave you from this video, You should have that as background before we get into bond price volatility and duration analysis. And so what duration analysis will do is it'll help us figure out how sensitive are bonds to changes in interest rates. So when the Fed changes interest rates, what do I expect the price change to be? So if the Fed changes interest rates 50 basis points, pushes them up 50 or 100 basis points, I wonder how much my bond price is going to change by. Well, that's what duration analysis is all about. And that's what we're going to cover in the next video.